Turn it over to
Thank
Stu.
you, Mike.
Yeah. This is futures
Um,
trading. Can't wait.
yeah, let me just do my sharing. Screen one. Go live. Okay, you should have be able to see a screen of mine. I was going to start off today with just a nice little tip for people that use TradingView. Some of you might know I'm on one of the beta testers for TradingView, and they've recently introduced a little thing on notes, and I'll just show you how it works. So if I go to this stock here, you can see there's this little note here that says that's kind of my notes to it, and I can click on it and take it to there. So if you have a stock and you're looking at something like this, say, you can hit the Alt N key and just put whatever your note is. I'll just type something there like watching, and just it's got an upside reversal, and then when I close that down, you'll see as you're flipping through your stocks, you get any little notes that you've had on things that you've said there. So that's a pullback buy I'm looking at or whatever. So just a little tip, new feature that they put in. So anything that you like, or you just want to remind yourself as you're flipping through those charts, you can hit the Alt N key to bring up the notes, type your note in, and then your little reminders will appear here, and then you can take yourself straight into your notes from there.
So that's giving you the title of the note that you made.
No, it actually gives you the whatever you put in here.
Oh.
It gives you the first line of the text of your note.
And that's of the most recent note, right?
Yes, it is. Yeah. So if I change that to don't trade this or something like that, and change that, you'll get that. You just get however much they can put on a line, basically.
Mm-hmm.
But it's a handy little reminder thing if you're flipping through charts and things, and you just want to remind yourself what you're thinking or looking at.
Yes, indeed. That is a cool feature. Thank you. Do you happen to know if there's videos or something that they've put together on how to write your own Pine scripts like that? That's something that I find myself coming back to, that idea of wanting to make some of my own things, and I don't know the first thing about doing it, and it would take me forever at this
Yeah.
stage.
So there are some YouTube videos that are pretty old now, produced by third-party content creators. It's actually quite densely technical, the documentation that they provide. The examples are not very clear cut, and they're designed for people that already know how to write scripts and codes. As I say, I think perhaps in the new year, Mike, we can do a kind of step-by-step on, one of the evenings during the week or something, and we'll take everybody through how to create an indicator. But there's some basics of how their type of scripting works, but also how, in general, computer coding works as well.
Is PineScript its own proprietary language, or is it based on another language?
No, it is their own proprietary language. It's very much it's quite. It seems to be based around some element of Java. Although you don't have to necessarily, all the declarators and things are quite Java-esque, but it is a procedural script as well. So it's obviously going up to some scripting engine that they then procedurally run through it, which essentially, rather than being event-driven or object-driven, it runs through from top to bottom. But it's based around series of variables, which is quite different from other kind of computer languages, if you like. If you used Python for finance or something like that, you'll be maybe a wee bit familiar with it. But they are trying to standardize it a bit more. And I mean, we've been through 3 variations in the last 2 years. We've gone from PineScript 3 to 4 to 5 now. So it's not fully stable yet, I guess. They're getting close, I think. But yeah, we can certainly do some one-on-one. You need to follow along with a screen, though, with it. That is kind of the difficulty there, Mike.
All right. Yeah.
Maybe it's better recorded as a lesson that you can pause and then go through at your own pace or something.
Yeah. Yeah. Well, we'll figure it out. We'll figure something out.
Yeah.
I appreciate the willingness.
Yeah, it's not a problem. Yeah. So anyway, that was just a little tip. I thought this was a great addition, to be honest, when we first got it, and I found it more useful over the last few weeks, and it should be on general release now. So, what was I looking for again? Oh yeah, futures. Okay. Yeah, it's just that there was a little bit of interest over the last few things about futures trading, so I thought I would take people through it to show you kind of how it works and what the differences are. So let me just put this up on present. Can everybody see that?
Yep.
Yeah, good. Okay. So I thought we'd start. There's some language differences and various other things in futures contracts, but what they actually are, how the contract sizes are what they are, because sometimes they seem a bit strange, and where they came from. They originally appeared in the early 1900s as a way of farmers and producers having a known price ahead of time for the likes of grain or oils and then livestock, that sort of thing. So really what a futures contract was some institution somewhere was saying we will pay you X for your wheat or your corn or whatever it was, and they took out a contract to do that. But then so the farmer would accept that contract. Essentially, he would buy that contract, and then, the farmer would sell the contract to the institution, and the institutions could trade around that basically, and they would trade it on to various other people, and hence futures trading was born. It kind of started in Chicago, and the reason why some of the contract sizes, like if you buy soybeans and stuff like that, it's 55,000 bushels, and various other sizes, lean hogs, 400 lean hogs and these things, is that was the amount that could fit into a standard size American railroad car at the time. So essentially everything was one railroad car full of whatever commodity it was they were buying, and they've kind of stuck with that ever since. So that's why the contract sizes are what they are. This also leads into your obligations under a futures contract, which we'll come down to in a sec. Nowadays, those full contracts are, in some cases, still the main contracts that are traded and provide the most liquidity. Soybeans, orange juice, all that type of stuff. Oil as well. But in other cases, the mini contracts. Now, a mini contract is a fifth of the size of a full contract, so it's 20% of the size of a full contract, and that particularly S&P. Most of the people have heard of the E-mini, which is a mini S&P 500 contract. So it's only trading no, it's not. It's 50 S&P futures 50 units of S&P. And then you get the micro contracts, which are a tenth, so 10% of the size of the full contract, and you get the nano ones, which are a hundredth. There's not too many nano contracts about, but they are becoming more popular with some of the online trading platforms. And you can see the size in there in oil, it's 1,000 barrels, 100 barrels, or 10 barrels for a micro. They don't do a nano contract in oil, because you'd only be buying 1 barrel, basically. They were really designed as institutional instruments, and hence why the rules are very different from the rules that govern the stock market. And they are vital to the real world economy, because they're actually all about delivering actual commodities or actual stocks or actual things in the real world to buyers in the real world. They're not synthetic, particularly, especially the more traditional ones. So, if you buy in copper and you buy, 1,000 bricks of copper or whatever, then when you take that contract on, your obligation is to deliver it or to take delivery of it. There is no such thing. It's not like options where you can choose to exercise them or not. Within a futures contract, you're obligated to deliver. And if you don't deliver, you're breach contract, or you're obligated to take delivery at the time and place designated within the futures contract. And if you don't, you're also in breach contract. So it's a really important distinction. That doesn't stop people trading them, because most people just roll them over. There's numbers of different ways to do that, but most people, when they're trading futures, will trade the rolling contract, which automatically just rolls over. For each individual commodity or thing that you're buying a futures contract for, there are 4 futures contracts in any 1 year, and they have delivery dates specified in April, July, October, and December. And the delivery dates are specified in the contract, but it's normally the 3rd working day before the 25th of the month, which you just basically look it up, but it catches people out all the time. But it's the 3rd working day before the 25th is the standard, when they're due to be delivered or to take delivery of whatever it is that you've got. Liquidity can vary quite a lot within futures, so you need to look at it. And when you actually look at any of the listing of them, you'll find that there's tens of thousands of different contracts. The reason there are so many is sometimes it's just where the delivery is going to take place. So it may be, if you look at oil, it'll be delivery to New York, it may be delivery to Amsterdam, to Kuala Lumpur, to Singapore, to Tokyo, wherever. And that's the differences in all those kind of contracts. But most people trade the standard one, and then will contract for delivery. Price moves, although in fact, they're all specified mostly in dollars, but there are alternatives. If you look at soy, for instance, it tends to be Malaysian ringgit that they use. But by and large, the price is quoted are in dollars, but you need to calculate your price move in ticks or basis points, simply because you're buying 1,000 of something or 100 of something or whatever. And the other key kind of thing about futures contracts is they are, in most contracts, a 24-hour market, but not all are a 24-hour market. So you need to check first. For instance, the two that I trade or like to trade, are oil and natural gas. Now, oil is a 24-hour market other than the 15-minute settlement period. Natural gas, however, is not. It starts at 5 a.m. UTC and runs through until 4:30 p.m. Chicago time. So, and then there's a gap every night. So you always have a bit of overnight risk with natural gas. You don't particularly have it with oil. Although if you go to sleep and you're showing a healthy profit, you might wake up in the morning and you're not. How does it work? Margin. It's very different from buying stocks on margin. Okay. When you buy a stock on margin, you're essentially borrowing a down payment from your broker to buy some assets. With futures trading, it's not that at all. It's a kind of goodwill gesture that you're putting to both your broker and the exchange. And usually you cannot trade futures through a stock account. You certainly can't in Europe, and I'm not sure that you can in the US either, because of different regulators and you're signing up to different terms and conditions. Your account may be able to do both, but generally they're separate accounts, and certainly are in my case. There are two types of margin required to trade a futures or to take a futures trade. So you have a thing called initial margin. Now, this is a fixed amount that's set by the exchange at settlement time for the next day. It tends not to vary that much, but if you were buying E-mini contracts, for instance, your initial margin is about $4,600 per position. What happens is that immediately take that position, that money is taken from your account and passed over to the exchange and held in an escrow account on the exchange. Your broker will also require you to have a maintenance margin. Now, you can generally ignore maintenance margin if you're day trading, because it's just an amount you would be paying out, and it's about 5,000, I think, on my broker for E-minis. But it's generally based on the total value of your position with your broker. This does fluctuate even on an intraday basis. So you'll often find that your initial margin in some instruments goes down overnight, actually, after the exchange settlement period, simply because the kind of the triggers go down as well. So they have there's various halts that are put in place, but during the day when it's most active, the halts are raised a bit. E-mini it's 7% and 12%, I think, of the halts, whereas overnight it's only 5%, just to reflect the lower amount of volatility that happens overnight on those things. So your actual overnight margin is less than your day margin, and so on. But they do, because they're based on the total value of your position. As your position moves up or down, then your margin requirements will change with your actual broker. A lot of people use it for day trading. You can day trade futures with quite low capital amounts, less than $25,000. But pattern day trading rules don't apply to futures trading at all. So hence why you're getting a lot of these micro and mini instruments that are becoming super popular. There's also no minimum tick rule. So you can short on any tick, you can short on down ticks or whatever. There's no none of that. So and there's no, you don't have to go trying to borrow stock and all that kind of stuff to shorten. So they're very easily shortable, and going short or long is essentially regarded almost as the same thing in futures trading. Another thing to bear in mind is the leverage can be extremely high. It's up to about 400 times leverage, particularly on foreign exchange contracts. So so you need to be warned about that, and a caveat. And I'm going to take you through an example of someone who didn't really know what they're doing, broke far too many rules, and ended up ruining their life trading this stuff. So this is just an idea. This is E-minis basically, or S&P futures. So if you want to trade a full S&P future, it's 2,500 as the quantity. So that's 2,500 of each of the stocks in the S&P 500. So it's 12,500 stocks or something. The initial margin for that is 52,000 per contract. Your maintenance margin is discretionary depending on your broker. To trade the ES or the E-mini contract, it's 500 of each of the stocks essentially, or 500 times the S&P 500. Your initial margin's $5,000. Your maintenance margin's $4,600. So if you were wanting to trade one contract, you need a margin. Your margin requirements are just shy of 10k. But remember, you're trading 500 times the S&P 500. I'm not sure what it's at the moment. Maybe a quick flip over S&P. What's the S&P at? Oh, it's the expiry on this 470. But so that's 500 times 500, $125,000 position or whatever that you've got on there. And then the micros are the easiest one to trade. Obviously, the ticker's MES. It's only 50 of each, and it's initial margin of 510 and a maintenance margin of 460. So when you're looking at futures contracts, you need to go into a few things before you even take a position. You'll find it all on the exchanges. If you're looking at trading an E-mini, just take E-mini contracts, and you'll pull all this stuff up. But it's cash settled to the SP 500 index on quarterly, expiration settled daily to the standard S&P. So the E-mini is taking its prices basically from the S&P 500, and that's what's used as the cash settlement. And I'll come on to settlement in just a sec. Ticks, so it's essentially 0.25 index points is a tick. So that means for every quarter of a cent that this goes up or down, your contract value is increasing or decreasing by $12.50.
So if you're doing the S&P, what is it that you're actually agreeing to take possession of?
So it's 500 shares. So if it's a full size one, well, let's take the E-mini because it's easier. So it's 500 shares of each component share of the S&P 500, whatever that happens to be on that date. So 500 Google, 500 Amazon, 500 Netflix, 500 of this, 500 of that. That's essentially what you are purchasing. It's a basket because it's an index. It's a basket of stocks, and you're taking that basket of stocks, one of each, and multiplying that by 500, and that's what you are essentially either taking delivery of or making delivery of.
And is there a time component to it?
The only time component is you are obligated to deliver them on the date the contract expires and at the place the contract expires.
And does each contract have like a different date, so you could pick like Monday, Tuesday, and so on and so forth?
No, they don't. No.
Okay.
No, they don't.
So then, how does the date? How is that determined?
They're standard, so they're quarterly dates. So every futures contract is deliverable in 1 or 4 quarters throughout the year.
Gotcha.
Okay. I'll come on to that in a little bit. See where I've got here, ticker HMUZ. So H is April, M is July, U is October, and Z is December. So when you're looking at the contracts, you'll see something like ES, H, and then a number after it. And sometimes you'll see something like ES, Z 36, and that means you need to make delivery in London of those, or whatever. So that's kind of how they work. But most people just trade the ES, and then there's a kind of exclamation point after it, which is the rolling contract. So if you look up the ticker for E exclamation point, then that's the rolling contract where they just automatically roll over. So there's no delivery ever taking place. They just roll on and on and on. So that's clear enough. By and large, you would pick a couple of tickers, and I'll show you a few in a moment. And you just stick with them rather than going into individual. You can get ESM, which would be delivery next July, so it's around about the 20th of July next year, and you'll have a number like 2, something which might be Amsterdam, but then you can also have a currency designator after it as well. They can get quite complicated, but you just need to know the basic kind of ticker. And if you were trading S&Ps, for instance, you'd either be on ES or MES. So the trading hours, 23 and 3/4 hours a day, 5 days a week. So comes on at 5 p.m. CST. I'm trying to think what C means, Central Standard or something like that. And closes on Friday at 4. And this is here. This is quite important. It's 3:15 to 3:30. This is the settlement time. So, and I'll just come on to what that means in a sec. And this here is your basis points. So this is kind of how you work out how much exposure and things that you actually have, and we'll go into kind of basis points in a moment. But often it's easier to work things out on a basis point, which basically for every cent or for every tick, how much or how little is your position going up or down.
Can you get in a limit up or limit down situation with any futures contract, or is it more likely to happen with certain types?
You can, you can, and you do, and they all have slightly different ones. So E-mini, for instance, during the daytime is 7% is the halt, and it's a 5-minute halt. And then 12% is the next halt, and then every 5% after that. Overnight, it drops to a 5% halt. So that's kind of how you could do it. I've got an example of where things went a bit crazy in oil last year, and how, I mean, it halted and halted and halted, but it still went down 45,000 basis points or something in the space of an hour. So I'm going to kind of go through mark to market, and this is why it's important when you're future trading to be super aware of this. So if you're trading ES, you've already had to put aside some of your account for margin. So for each contract, about 10k. At settlement time, what happens is they take, there's a strike price is reached, and for on ES that's at 3:15 Central Time, Whatever that price is, that is the settlement, and all contracts are settled at that point. And what that means is that if the difference between when you bought the contract and now is greater, then money will be immediately transferred to your account, to your trading account. That difference is transferred to it. If it's lower than what you bought it for and you were long, that money is immediately taken out of your account. So that means you can get some quite wild swings in your P&L sometimes if you're trading futures, because the money is dumped in straight in every single day. It's also when all the day traders exit their positions in the kind of 10 minutes before settlement, they try and get out of there. 3 p.m. is the exchange time for margin calls. So if you have any open position at 3 p.m., automatically calculates what your margin requirements are, checks what you have put in as your initial margin and your maintenance margin, ensures that you have enough to cover through settlement, and if you don't, that's when you get a margin call. And you've got 30 minutes to get that money in your account, or else your position will be forcibly closed, and you will also then get a bill for what you owe if you can't do it. That's where you get the forced closure and breaches and things like that happen all the time, when people are unaware of what their actual exposure is, and how long they can keep that exposure going. So you need to be a little bit careful around that kind of stuff. Normally, if you're trading sensibly and within your means, it shouldn't be a problem, but you need to be well aware of it. The other thing about futures trading is you can have on-market stops, but most brokers will allow you to have an off-market stop that only triggers sometimes with a confirmation when the price is hit, because futures traders and all that are great at running stops and bouncing it back up, and it doesn't take too many of them sometimes to manipulate that market. So a lot of people don't like to have them on exchange. So you just need to be aware of that. And before I go into this lesson and read, so a map to market example of what it actually means. Say an example I had here was just for simplicity, but if you had a $50,000 account and you bought one contract of oil at $60, so your initial margin and your maintenance margin are 9.7, something like that, and that's you now bought 1,000 barrels of oil at $60, so you got $60,000 position. At the end of the day, if the oil closes at 62.5, your position is now 62,500 because you got 1,000 barrels, remember. So that $2,500 difference is immediately transferred to your account. However, if it closes down, say it went down to 55, essentially your position is now $55,000. So an additional $5,000 is transferred from your account. Not the margin, but as an additional $5,000. And you still need to maintain enough for your margins. So that's kind of how it works. Well, what a lot of people use is basis points for the ease of calculation. So one contract of oil is essentially $10 for every cent that oil moves. So you can then use that $10, and if it moves $2.50, that's 250 times 10 is 2,500. That's kind of how most people work in basis points in futures trading. I'll go back to this lesson in ignorance, greed, whatever. Now, it's a bit of a sad tale, to be honest, but it is how you blow your account, lose your house, lose everything you ever had, and are still going to keep losing it for the next 20 years. Essentially because ignorance is no defence in law, and you are legally bound to pay your debts. And what happened if I go to oil, you will see this is oil back in April 2020. You might have seen some of this stuff in the press or whatever. But if you look at this chart, and every stock trader will look at this chart and go, that's a pretty clear downtrend. However, we had our individual was trading oil, and he had been trading up and down a bit, and he bought this kind of bounce off the dip here and made $70,000 doing that. So when he saw it coming down to this area here, and he was ready to buy again, and he took a trade on this day here. So he took a trade about here, and then we lost some money on it, and he just watched as things went on. Now oil kept going down, and during the day of the 20th, which is expiry day, and apparently that he thought it was the 25th, but it's the third business day prior to the 25th. So this was expiry day, and the price just kept going down and down and down. And at this point, he bought some contracts around here. Now he had a $70,000 account, but the margins, initial margin and stuff had dropped down because he's buying 10,000 barrels at 10, so it's only a 100k contract at this point. So he could afford to buy something. He bought 14 contracts of oil, thinking it won't go much lower, and then it did, and it went down nearly to zero, and he bought some for a cent. So he filled his boots at a cent, not realizing that future contracts could go negative, exacerbated by the fact that there was a fundamental reason they were going negative, because if you remember, you have to take delivery. And the problem was it was COVID, all the oil tankers were full, there was nobody offloading stuff, so there was nowhere for the oil to go. So nobody wanted to be holding the oil contracts when delivery was due, because nobody had anywhere to put it. So that was the problem. Further exacerbated was the fact that his brokerage, which is the same one that I use, which is Interactive Brokers, on their charting package, their charting package didn't show anything below zero. So what he did was he saw it at zero, even though his ticker was going down. And then I can't get a lower time frame than this, but this actually happened in about the last 15 minutes before settlement was due. The price dropped to -40, and settlement was done at -26. So on a basis points, that's 26,000 basis points that he's lost at $10 times the 15 contracts. Ended up he was 9 million in the hole. So he was forcibly closed out. He sent the bill for $8,900,000. Been through a bit of a court case with it and all that. I think IB stumped up some of the money, but he still owe them a sizable fortune. So he's going to be paying that off pretty much for the rest of his life. So it's just a wee salutary tale. You need to kind of know what's going on in these things. As I say, they're designed as institutional contracts. To lose $9 million is no big deal for a bank. To lose 900 million is probably a bit more of a deal for a bank, but they can probably recover from that. But as an individual, you certainly can't.
But he was going long in a clear downtrend.
Yeah. I mean, when you look at it, I mean, it breaks every rule of trading, doesn't it? Clear downtrend. He's not seen a bounce, but it was the thinking, I think, that caught him out that, well, it can't go lower than zero. Well, yes, it can. And that you should have been ringing alarm bells when everybody was selling. Nobody was buying, and he couldn't even clear out of his contracts because the liquidity just disappeared. And the halts came in, and the settlement actually happened during a halt. So
can you explain the limit down situation? I mean, when it halts, does that give you a chance to sell the contract if you happen to be in this situation?
Well, you can only sell it when the market reopens, but if there's no bids, there's nobody left to sell it to.
Okay, so how does limit down work then if there are bids? How do you,
Yeah, you just have to be quick when you come back in, basically. But there's no. It's just a circuit breaker to give everybody a chance to break out. The other key thing, I suppose, about futures contracts, particularly E-mini, it's super heavily algo traded. It's all algorithms that trade that stuff. So it actually very rarely gets to a point where it does go limit up or limit down. Other than the usual, if you get a runaway algorithm or something, I suppose it will do. But I haven't seen one for many years, and this oil one, when it happened, was quite big news, because it doesn't happen that often, because it's mostly algorithms that are trading these things.
okay, so limit up or limit down just means that the circuit breaker has kicked in. Is that what it
Yeah.
really means?
Yeah, basically they clear it. They also sort of partially settle, if you like, all the stuff that's just happened in the last bit to get to there, so that there's a clear statement of who's got what, and then trading restarts.
So the problem you run into is that there's just no bidders for whatever you're holding.
Yeah.
Okay.
Particularly here, and this, I mean, this is in UK time, but that's 1900 would be. This is in the run up to expiration of that contract. So that would be 2 p.m. in Chicago that started, and then you're settling out margin settlement basically at 3, and then final settlement here. So yeah. So just nobody wanted take delivery at this point. No, it's a problem. So yeah, unfortunate, but kind of his greed got the better of him. He might have survived if he'd only had one or two. He might have got off, but not going to sell 1 million barrels of oil just like that, unfortunately. So that was that. Yeah, time zones. Trading futures, you got to be aware that there's a number of things. They're not all the same. There's within each different instrument, there's often a leading and a reaction time zone. But there's essentially 3 key time zones for trading. So it's usually determined that an overnight session is kind of the Asian session, and if any of you have traded Forex, you'll be familiar with this kind of concept. But so the Asian markets kind of lead and lag the day. Then the European markets kick in about 6 hours before the US markets. Then the US markets, and then back to the Asian markets. Now, different things trade different quantities on those markets. So if you look at things like soybean, for instance, the Asian markets lead that, and whatever happens in the Asian markets, because they're the primary producers, remember, whatever's happening there tends to then get mirrored or reacted to by the European and the US markets. Similarly, precious metals, often led by the Asian market. Oil and gas and energy, different, often led by London and reacted to by the US markets. So you can take advantage of some of those things. But each one has a personality that they're very much not like stocks. That you don't go through a watch list of 200 futures contracts and look for patterns and all that. You pick 2, 3, 4, 5 or whatever. I look at 5, but and then you just learn them and how they react and all that. And they're all slightly different, but they're potentially slightly easier to trade in stocks because you're not flipping between a bunch of different names. It's a single instance, single commodity, and you learn how that market works and what things work in that market and what doesn't, and what moves it and what doesn't. They can be very, very news driven. Settlement periods often differ, so you need to make sure you know when the contract and where the contract settles. So it depends on what the primary exchange is, whether it's London, Tokyo, Delhi, Amsterdam, or Chicago, or New York, and you just need to work around that. And one of the things is the key opening at each of those time zones and time zone ranges are often the best ways of trading futures. So a couple of techniques. These are the ones that I use, but there's probably a whole bunch of different ones. There's a thing known as the London Ledge, which is happens in oil, gas, and currency markets. Take you through that, but that's essentially a pop. When London opens, price pops up by a fair bit and then consolidates really tightly until New York opens. And at that point, it either shoots up again or it sinks. So you can trade that. The Asian range, this works on gold and silver particularly, but other precious metals and some of the financials as well. Often you'll see things like, the Hang Seng, I think it's called, and the Japanese indexes. They can sometimes set the tone for the day, so sometimes you can trade out the ranges on those. Another thing about futures, they tend to be pure price action. They trend very, very strongly, and they tend to either go up or down. They very rarely go sideways. So they really are the trend is your friend type instrument. So you really need to trade them on pure price action rather than looking for any kinds of patterns. See heads and shoulders and all these kind of things. You forget all that stuff. It's pretty much support and resistance is what you're trading around. That pure price action stuff. Indicators and things don't help much. You're more or less looking at price bars. And the other thing is seasonality. A lot of people trade the seasonality of them. There's highs and lows for all these different commodities when they're in demand, and you can track kind of seasonal profiles to them. So I don't know. Am I taking too long on this, Mike?
No, I don't think so. Keep providing value, and you could go all day.
I probably could, yeah.
Do you typically trade those futures in pairs, or is that only for currencies?
No, that's currency trading. Yeah. So I mean, these are the ones that I look at. But natural gas, for instance, I took quite a big trade on that one. But gas, if I can read my notes. Yeah, gas is a strange one because you're buying 10,000 standard thermal units, which is essentially $10 per basis point. But this goes down to the thousands, so it's a tenth of a cent is your tick in these. And I think this was a London Ledge actually. If I look back, where's this? I'll show you what one of these things looks like. Click on there. Yeah, it was. So this is the London Ledge. So this is the London Open. Price skyrockets up, then tightens up in here. So you get this kind of 1, 2, 3 move, and so I put a buy point above there, a stop 40 basis points below 20 contracts, and then when New York opens over here, off to the races, and I got 495 points of that, so 10R basically on that one. And then you can, I just kind of mark the ranges in, so and then I traded it. Well, I don't know if it's this week sometime. And then oil is a similar sort of thing. The kind of London Open, buy it, sell. So that's kind of how they work. Ranges, silver. I was looking at a range the other day to give you an idea. You do get various indicators that show you when the various opens are, but they do kind of clutter up your charts. But this is an example. Here it is. So this is an Asian range in here. So the Asian session popped up. So you can then trade the break of that, when the London or New York opens, and off you go. Again, you can look at where the low of the Asian range is, and then trade a break below it, and so on. But I've taken up a lot of time, and I apologise for that. But you can see I trade the like NG1 continuous contract. Oil, silver, treasuries, or soybean. And soybeans is probably showing you a bit of a seasonality dip at the moment. So coming down, probably start to go up. But you can see how these trend. You get long, continuous trends within all of them, essentially. They very rarely go sideways. So if you're a trend trader, they're a great instrument for trend traders, and I think a lot of the market wizards and all that kind of stuff, if you ever read any of their books, that's where they kind of made all the money. And turtles and all that kind of stuff, they were all futures traders.
Don't you need to have a lot of margin though to hold it through a move like this?
What you have to, you don't, well, you see, you don't really, because remember, you get settled every single day. So as the stock moves up, the margin increases a little bit, but you're also getting a constant feed of income into your account every single day. You get more and more money in your account. You don't get the money when you exit the trade. It comes in every single day because it's mark to market.
Okay, so if you were trend trading this and you got in the beginning of the move, your account would be getting a lot larger, and then when it starts to drop, you'd probably be out of it.
Yeah, and that's where the turtles and all these kind of guys. So if they bought this sort of break here, they're getting money coming in here, and then they might have held through that dip, or they might have sold there. Who knows? But if you were in this big trend here, you're getting lots and lots of income coming in. I mean, that's millions of dollars on even a 10, even 10 contracts or whatever. As that's coming in, what they were doing is pyramiding in every time. So every time there was a pullback to the 10 EMA, like they would pyramid in again. They would take all this money that had come into their account here, add it in. So they become self-pyramiding contracts. And that increase in margin as you're going up is paid for by all the money coming out of somebody else's account. And that's what you've got to be very aware of with these kind of futures contracts, is there's two sides to every trade, and it's very obvious in futures trading, because you're either giving that other person some of your money or they're giving you some of theirs, and that happens on a daily basis. It's not you can't sit through a down. If you lost 20% or something on that, you can't sit through it. It's not a theoretical loss, it is an actual loss that day. So you do have to switch mindsets a little bit from stock trading. But the easiest way to do that is, as soon as you're up, by about half your risk, you get your stops moved up. You just can't let these things go against you. So you need to be, especially in the early stages of any trade, you need to be in and out quite quickly. And if it goes for you, then great. But don't let one ever go against you. And you certainly can't sit through a pullback without ruining your account. Don't let one go against you, basically. Was that helpful to people?
Yeah, it's very helpful still. I have a question.
Yeah.
Or do you look at open interest on your contracts to gauge whether the trend is going to continue or not continue?
I just look at the price action. I try and just steer away from everything else. And you any of these charts, I think oil. If you pick up any of them and just look at them, you see that everything happens around support and resistance. You really just have to get into your pure price action head on and
Yeah,
say,
I had read somewhere in one of the books that an open interest, the number of contracts, the open interest on the contracts, if the open interest is increasing, and usually the trend that's in place will continue, and if the open interest is decreasing, it could give you a hint that maybe the trend may start to turn. I don't know if you've ever heard of that.
I've heard people mention it. It's not something that I truly understand or have done any research on, to be honest. I know you get these forward curve things that you get, and you see all the different contracts as you flip down through them. But they are essentially what the forward contracts are priced at. Some of these are way into the future though.
Okay.
So I'm guessing they're assuming that oil by 2027 is going to be $60 a barrel at the moment. So, okay. Thanks everybody, and thanks Mike. I'll pass back to you.
Fantastic stuff, Stu. Thank you. Definitely a lot to think about on that one. Now, it's interesting too how at least part of what we learn about in one asset class can be applied to another, and it's interesting to see too what we need to do in a different asset class, expand our horizons.